Sometimes, it really makes you think. Like when you see these breakthroughs, these big leaps forward, it makes you wonder if we're just stuck in a rut using the same old tools.
Yeah, I see what you mean.
Take marathon running.
Yeah.
For the longest time, it was all about this, that, or the other training method, right?
Yeah.
And then boom, VO2 max hits the scene. Suddenly, runners are smashing records left and right. It's like a whole new level.
It really does make you wonder, doesn't it? Like, are we missing out on these kinds of game changers in other areas just because we're so used to the same old way of doing things?
Precisely. And that brings us to our deep dive today. We're taking a closer look at trading, specifically a less-known indicator called the David Ti Oscillator, or DVO for short. The big question is, can this thing give us an edge? Can it tell us when a price is about to snap back like a rubber band to its average?
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Yeah, the research we've been digging into really dives deep into a strategy built around this DVO, not just what it is, but how it performs, the whole 9 yards, and most importantly, why it might actually work.
So let's get down to brass tacks. What exactly is this DVO and what's it supposed to do?
Okay, so imagine you're trying to spot these quick bounces in a stock price. You know, those little ups and downs that happen regardless of whether the stock is generally going up or down over a longer period.
Gotcha.
Well, the DVO is designed to be a leading indicator, a sort of heads up. Its job is to cut through the noise of the overall trend and zero in on those potential reversals.
So how does it do that?
It essentially looks at where the current price sits within its recent ups and downs, its short-term range. But here's the kicker. It does this after adjusting for the overall trend. Think of it like leveling the playing field.
Leveling the playing field. Okay, I like that.
And it boils all of that down to a rolling percentile. It's like saying, okay, in the last X days, after accounting for the general trend, the price is currently ranking in the top 10% of its recent fluctuations, something like that.
You mentioned adjusting for the trend. How exactly is that detrending done in the DVO calculation?
It's actually pretty straightforward. They use a simple moving average, an SMA, of a particular ratio.
A ratio. Okay, what ratio are we talking about?
They take the closing price and divide it by the average of the high and low prices for that same period. This way, you're sort of normalizing the price action. You're not just looking at the raw price, but how it's moving relative to its recent high and lows.
It's like taking out the background noise, so to speak.
Exactly. You're focusing more on those little wiggles and wobbles within the stock's recent range rather than getting distracted by the bigger picture trend.
Now, the research we're looking at uses the DV2, the two-period DVO. Is there a reason they chose that specific look-back period?
The two-period DVO, DV2, is kind of like the counterpart to the two-period RSI, RSI2. You know, the RSI is a pretty popular indicator out there.
Right, the relative strength index.
Exactly. So using the DV2 makes for a nice apples-to-apples comparison. You can really see how these two short-term oscillators stack up when it comes to spotting those mean reversion trades.
Fair enough. So we have a basic idea of what this DV2 is trying to do, but does it actually work? Is there any evidence to suggest that it can actually give us an edge in predicting these quick reversals?
Yeah, that's the million-dollar question, right? To answer that, the researchers did a pretty extensive analysis. They looked at a huge pool of stocks, all the current and past members of the Russell 3000 index.
That's a lot of data.
Oh yeah, it's a comprehensive data set. They went hunting for every single instance where a stock's DV2 closed below a certain level, 10 to be exact.
That's our signal, right? DV2 dipping below 10.
Not so fast. They added a little twist. They only considered these signals if the stock's closing price was also above its 200-day simple moving average.
Ah, I see. So not just any dip below 10, but only if the stock is still in a generally upward trend over the long term. Makes sense.
Exactly. They're looking for those little pullbacks within a broader supportive trend. Kind of like catching a falling knife, but only if you're pretty sure it's going to bounce back up.
So they found all these instances where the DV2 dipped below 10 while the stock was still above its 200-day moving average. Then what?
Then the fun part. They pretended to buy those stocks at the next day's open and held them for 5 trading days, and they tracked how those trades would have performed.
Okay, drumroll please. What were the results?
Well, on average, these DV2 triggered trades yielded a 2% return over those 5 days.
2%, huh? Not too shabby for such a short holding period.
Right. And what's even more interesting is that over half of those trades, 54% to be precise, ended up in the green. And those winning trades raked in an average gain of 7.6%.
So more winners than losers, and the winners were winning big. Sounds promising.
Of course, there were some losers too. 46% of the trades resulted in a loss, with an average loss of 4.7%. But even when you look at the median return, which is less affected by those extreme outliers, it was still positive, 0.3% to be exact.
All right, so it's not a guaranteed home run, but there's definitely something there. Now, how did this compare to those times when the DV2 wasn't flashing a buy signal?
They looked at those scenarios too. They called them non-events, basically, when the DV2 was above 10 and the stock was still above its 200-day SMA.
So business as usual, no particular signal to act on.
Right. And as it turns out, in those cases, the expected returns were worse. Not just the average return, but the median return too. And the win rate dropped to 52% compared to 54% when the DV2 was below 10.
So statistically speaking, is that difference in performance significant? Like, is it enough to say that the DV2 is actually adding value here?
Good question. They ran the numbers, and the p-value for the difference between those two sets of returns was 0.017.
0.017. Okay, for those who aren't statisticians, what does that tell us?
Well, it's definitely below the commonly accepted threshold of 0.05. In simpler terms, that means it's pretty unlikely that the difference in performance is just due to random chance.
So we can be reasonably confident that a DV2 reading below 10 with the price above its 200-day moving average does seem to give us a statistical edge for a short-term bounce.
Seems that way.
Now, the research also compared this DV2 strategy to a similar one, using the good old RSI2.
Yeah.
What did that comparison reveal?
They went through the same exercise, but this time looking for instances where the RSI2 closed below 10 while the price was above its 200-day moving average. They tracked the 5-day returns, and guess what? The median expected return and the win ratio were remarkably similar to what they found with the DV2.
So both indicators seem to be about equally good at spotting these potential reversals.
On the surface, yeah. But here's where things get really intriguing. They dug deeper and looked at how often both indicators gave a buy signal at the same time. You know, both DV2 and RSI2 dipping below 10 on the same day.
I'm sensing a but coming.
And you'd be right. It turns out this simultaneous signal only happened in about 20% of the cases.
Only 1 out of 5 times. Wow, that's a pretty small overlap.
Yeah, it is. And it tells us something very important. Even though both indicators seem to have a similar ability to pick out these short-term reversals, they're actually identifying different opportunities. They're reacting to different nuances in the price action.
It's like they're each tuned to a different frequency, even though they're both playing the same song, so to speak.
Precisely. And this raises an interesting possibility. What if, instead of choosing one over the other, you could combine them? Maybe use them together to get an even more robust signal.
That's a fascinating thought. And it goes to show that even when indicators seem to be aiming for the same outcome, they might be seeing the market through very different lenses. Now, the research also touched on the role of volatility. What did they find there?
They used a metric called the normalized average true range to measure volatility. And what they found is that generally, the higher the volatility, the juicier the potential returns on those DV2 triggered mean reversion trades.
So more volatility, more opportunity.
In a nutshell, yes. It makes intuitive sense if you think about it. Higher volatility means bigger and faster price swings. That can create those more pronounced dips below the average, which is what we're trying to exploit with this strategy.
Gotcha. So higher nadir is like adding fuel to the fire. It amplifies the potential for a successful mean reversion trade when the DV2 is signaling oversold.
Exactly. It's like the difference between a gentle wave and a tsunami. Both are waves, but one has a lot more power.
All right, so we've got an indicator that seems to have an edge, and we know that volatility plays a role. Now, the next step in the research was to put all of this together into an actual trading strategy. What did that initial strategy look like?
So this initial strategy focused on the S&P 500 stocks. It was a pretty simple setup. They divided their capital equally among a maximum of 10 positions.
Okay, 10 stocks at a time. What was the entry rule? When would they buy a stock?
Each day, they'd look at the previous day's closing DV2 values for all the S&P 500 stocks. Any stock that closed below 10 would be a potential buy.
But what if more than 10 stocks triggered that signal?
Good point. If that happened, they'd prioritize the stocks with the highest nadir values. Remember, higher volatility, potentially bigger returns. They'd pick the top 10 based on volatility and buy those at the next day's opening price.
And what about the exit rule? When would they sell?
Simple. If a stock closed above its previous day's high, they'd sell it at the next day's open. No messing around.
Pretty straightforward. So how did this strategy perform when they put it to the test in a backtest?
The results were pretty impressive, actually. The strategy generated an annualized return of 17.4%.
17.4%. That's more than double the historical return of the S&P 500 over the same period.
Right. And not just that, the Sharpe ratio, which measures risk-adjusted return, was also much better, 0.87 compared to the S&P 500's 0.51.
So not only higher returns, but better risk-adjusted returns as well.
Exactly. Now, there was a 34% maximum drawdown, which is something to be mindful of, but it's still better than the S&P 500's 57% drawdown over the same period.
Okay, so some bumps along the way, but overall, a pretty smooth ride.
Pretty much. The strategy traded fairly actively, averaging around 475 trades per year. That's about 2 trades per day.
So not a buy and hold approach.
Not at all. It's a more tactical strategy. And the win rate was pretty solid, 64.8%, with an average expected return per trade of 0.36%.
Not bad at all for a strategy based on just one somewhat obscure indicator. Now, the researchers didn't stop there. They also ran the same backtest using the RSI-2 instead of the DV2. Did that yield similar results?
You know what? It did. The RSI-2-based strategy produced pretty comparable numbers across the board. Annualized return, Sharpe ratio, maximum drawdown, all in the same ballpark.
So both strategies performed about the same overall.
Yeah, but here's the catch, and this goes back to what we talked about earlier. When they looked at the actual individual trades executed by each strategy, the overlap was incredibly small. Only 6.7% of the trades were the same.
Wow. So even though the two strategies ended up with similar overall results, they were taking very different paths to get there.
Exactly. It just goes to show that different indicators, even those aiming for the same type of outcome, can be picking up on different signals, different market dynamics. It's like two chefs using different ingredients to create dishes that taste remarkably similar.
That's a great analogy. It really highlights the importance of understanding what's happening under the hood, so to speak. It's not enough to just look at the final results. Now, the research also explored ways to potentially improve the DV2 strategy. What kind of tweaks did they make?
The main improvement they implemented was adding a third entry condition. So now, in addition to the DV2 closing below 10 and the price being above its 200-day SMA, they also wanted the stock to have had a positive return over the past 6 months.
So they're basically saying, don't just buy any stock that's dipping, buy stocks that have been doing well overall.
Right. They're adding a momentum filter. The idea is that stocks that have already been moving upwards are more likely to bounce back from those temporary dips and continue their upward trend.
So it's like riding the wave, but only hopping on if the wave is already heading in the right direction.
Precisely. And the results of adding this filter were pretty significant. The annualized return of the strategy jumped to 20.9%.
It's a pretty nice boost, over 3 percentage points.
Yeah, not too shabby. The Sharpe ratio also improved, reaching 1.01. So again, better risk-adjusted returns. The maximum drawdown remains similar, but other key metrics like the expected return per trade, the win rate, and the payoff ratio all saw positive changes.
So all in all, a worthwhile improvement.
Definitely. They also analyzed the month-by-month returns of this enhanced strategy going all the way back to 2004.
That's a pretty long track record. What did that long-term analysis reveal?
One thing that stands out is the consistency. In those 21 years, there was only one losing year.
Only one. That's pretty remarkable.
Right. And most of the months were profitable, 64% to be exact. The average winning month saw a gain of 36.7%.
36.7%. That's a huge month.
It is. Of course, there were losing months too, about 36% of the time. But the average losing month was only down 12.7%.
So the winners were winning bigger than the losers were losing.
Yeah, that's a good way to put it. They also looked at the streaks. The longest winning streak was 11 months, while the longest losing streak was only 4 months.
So more green than red, and the green streaks lasted longer. That's encouraging.
Definitely. Although it's important to remember that past performance is never a guarantee of future results.
Absolutely. Always a good disclaimer. Now, of course, trading in the real world isn't free. There are commissions, slippage, all those pesky costs. The research briefly touched on the impact of trading costs. What was the gist of it?
As you'd expect, higher trading costs eat into the strategy's returns. Since this strategy trades pretty frequently, those costs can add up. It's something to consider if you're thinking about implementing this in real life.
Makes sense. It's one thing to see great results in a backtest, but it's another to replicate those results after accounting for real-world frictions. So, as we wrap up this deep dive into the DVO and the strategies built around it, what are the key takeaways? What should our listeners walk away with?
Well, I think the big takeaway here is that sometimes it pays to venture off the beaten path. There are all these lesser-known indicators out there, like the DVO, that can potentially unlock new opportunities, new ways of looking at the market.
And the fact that a DV2-based strategy could perform just as well as an RSI2-based strategy, but with almost completely different trades, is really telling.
It really is. It tells us that these two indicators, despite aiming for a similar outcome, are sensitive to different market dynamics, different signals, and that opens up exciting possibilities.
Like maybe combining them or using them in conjunction with other strategies.
Exactly. It's all about expanding our toolbox and understanding the nuances of each tool.
And let's not forget the improvements they made to the DV2 strategy by adding that momentum filter. There's always room for refinement, always room for improvement.
Absolutely. And who knows what other tweaks and optimizations are out there waiting to be discovered. It's an invitation to keep exploring, keep experimenting.
It really is. So as you're reflecting on all of this, think about this. Whether it's in sports, finance, or any field, the constant search for new indicators, new ways of measuring and understanding the world, is what drives progress. It's what helps us see things in new ways and unlock hidden potential.
It's like putting on a new pair of glasses and suddenly seeing the world in a whole new light.
What other seemingly unrelated fields, what other VOT max moments are out there waiting to be discovered? What unconventional indicators might be hiding in plain sight, just waiting for us to uncover their power? It's a question worth pondering.
It certainly is.
Thanks for joining us on this deep dive. It's been a fascinating exploration.
My pleasure. Always a good time to chat about these kinds of things.
Until next time, keep those minds open and those curiosity levels high.